Today, I am going to explain the book Angel: How to Invest in Technology Startups by Jason Calacanis. At first glance, the title of the book might seem off-putting. Don't worry, this book is not about teaching the success of the rich, but rather about introducing you to a profession that specializes in making big money: angel investing. Why do we say that angel investors specialize in making big money? It's because they invest in startups at their earliest stages. These investments are highly risky, but if successful, the returns far exceed those of bonds, gold, index funds, and other more stable, mature investment tools. For example, if you had invested $1,000 in Apple when it started in 1976, by 2018, that $1,000 would have grown to about $15.2 billion. This is the kind of return an angel investor might achieve. Of course, this is an extreme case. Most of the time, angel investors sell their shares 3 to 4 years after acquiring them. If the startup aligns with the market, it should have grown enough in 3 to 4 years to attract mainstream capital, such as going public or being acquired by a large company. At that point, the startup no longer needs the help of angel investors. From this, we can see the unique aspect of angel investors. They move before the capital and seize opportunities before mainstream capital steps in. People often say that capital is smart. By following the flow of capital, you can see the most efficient areas in the market and the economic ups and downs. But for angel investors to succeed, they need to be smarter than the capital itself. They need to anticipate the capital's anticipation. Unlike predicting prices for traditional asset classes like stocks and bonds, which rely mainly on data and model deductions, angel investors must use their industry intuition, experience, and other senses. Each angel has their own secret method. This book aims to unlock a representative set of these methods. The author, Jason Calacanis, is one of Silicon Valley's most famous angel investors and the first investment scout hired by top venture capital firm Sequoia Capital. By July 2017, just 6 years into his angel investing career, he had amassed a portfolio worth $150 million. Among his numerous investments, the most famous is the ride-hailing app Uber. When he started angel investing, he decisively invested $25,000 in Uber, then valued at only $5 million. Uber's explosive growth later brought him more than a 1,000-fold return on his investment, cementing his top-tier status in the investment world. In the book, the author breaks down almost every critical point an angel investor will encounter, sharing his personal experiences and practical insights, along with many behind-the-scenes stories of today's tech giants during their startup phases. In the following analysis, we will look at how the author transformed from a poor kid from Brooklyn to a billionaire angel investor in 3 stages. First stage: how the author amassed the initial funds to start angel investing. Second stage: how the author broke into the angel investment circle and built his network and resource base. Third stage: the author's experiences in actual investments, focusing on the key strategies he uses to select investment projects. First part: the initial stage. We all know that to become an angel investor, you first need capital to invest. However, at the beginning of his career, the author was just a poor kid fresh out of school, like most young people. How did he accumulate the funds needed for angel investing? At that time, the author used a 2-pronged approach. He started his own business while also working as a consultant for startups. His first venture was a magazine called Silicon Alley Reporter. With the advent of the internet, the magazine transitioned into an online site collecting and publishing new trends in Silicon Valley, which was later acquired by Dow Jones. This entrepreneurial experience lasted almost 7 years and did not bring him much wealth. However, during this long incubation period, he accumulated a wealth of knowledge and connections related to tech startups, as well as skills in market promotion and public relations. This allowed him to subsequently provide consulting services to several startups. Consultants do not need to buy equity. They exchange knowledge, skills, connections, or reputation for shares in the company. Before entering the field of angel investing, the author provided consulting services to 6 companies, with the first 3 alone bringing him $700,000 in returns. Meanwhile, he continued to start new businesses with considerable success. For example, the blog company he co-founded, Weblogs Incorporated, was later acquired by AOL for a high price. During this long period of starting businesses and assisting startups, the author gained a deep understanding of tech startups. Just as someone who has been through the furnace can develop a discerning eye, this incubation period allowed him to keenly sense which startup projects could withstand the test of time. However, the author says that if he could go back and do it again, he would choose a different route, directly entering the angel investment industry. Why? The author explains that back in the 1980s, when he was in his 20s, he already had considerable exposure to and understanding of the computer field. He knew that companies like Microsoft and Cisco would grow into giants. For example, he realized that the transition from the DOS system, commonly used at the time, to Microsoft's Windows system would be a significant leap. DOS, with its command line interface, made computers a secret club for a few, while Windows' graphical interface and mouse would make computers accessible to the masses. The author says that if he had invested a few $100s in Microsoft and Cisco before they went public in the late 1980s, he could have made tens of thousands early on, avoiding the later convoluted process of saving money. This may sound like hindsight, but the author uses this missed opportunity to remind readers not to let poverty limit their courage and kill potential returns. Instead of spending hundreds of dollars a month on various TV packages or video memberships, he suggests saving that money for project investments. Even if you only invest $500 in each company, you would have invested in over a dozen companies in 5 years. One of them might bring hundreds or even thousands of times the return. Even if not, the experience will help you build investment intuition and connect with various entrepreneurs and investors earlier. The author also points out that today's young people have greater advantages in finding projects. They don't even need to travel around. They can invest alongside experienced angel investors simply by opening their laptops. A decade ago, this was impossible, but in recent years, many legal institutions specializing in angel syndication have emerged in the U.S. On these websites, successful angel investors form syndicates, detailing the fields they usually invest in, the companies they have invested in, the typical investment amounts, and the commission after a project succeeds. New angel investors only need to register on the site and join one or more syndicates to invest a small amount in each startup the syndicate approves. Additionally, the author offers some advice on choosing syndicate investment projects. He believes investors should focus on several project characteristics. The lead investor should have at least 5 years of investment experience and have invested in at least one well-known unicorn, a private startup valued at over $1 billion within 10 years of founding. Moreover, the startup should have at least 2 founders to ensure continued operation if one leaves. The startup must also have launched a product or service, not just be a concept on paper. In the author's view, participating in 10 or so syndicate investment projects before formally entering the field isn't just about financial returns. It's also about expanding your network and building your reputation. Second part, establishing a network. After the initial stage, once you've accumulated some capital and experience, it's time to leave the warm bed of syndicate investments. The best projects are usually not publicly listed on these syndicate websites. You need to independently screen investment projects, thoroughly investigate companies, and meet entrepreneurs in person. According to the author, an angel investor must evaluate at least 10,000 startups over 10 years, interview thousands of founders, and invest in about 200 projects to find a few successful ones. This makes the process of screening investment projects like panning for gold. You need to sift through a lot of sand to find the gold. So how do you do it? Imagine you want to maximize your gold panning success rate. Is the first thing you do to pick up your tools and start digging? Probably not. You should first determine where the richest gold deposits are, then start digging there. The same principle applies to angel investing. You need to seek projects in fertile ground for innovation and entrepreneurship because this is where the next unicorn is most likely to emerge. In the US, the author makes it clear you must go to Silicon Valley. Over the past 50 years, no place has brought more change to the world than this small peninsula. Giants like Google, Facebook, Apple, Twitter, Uber, LinkedIn, and eBay were all born in Silicon Valley. The best and most promising tech talent and entrepreneurs often come to Silicon Valley. If the best entrepreneurs come here, the best angel investors must also come here. After arriving in this land of opportunities, can we roll up our sleeves and get to work? Not quite. Extracting the gold hidden underground requires more than just a newcomer's strength. The hottest projects are usually quickly divided among seasoned veterans in the investment community before you even know about them. Therefore, you must quickly integrate into this circle and leverage the information and connections within it to access the best projects. The author calls this process building a project sharing network. How exactly do you do this? First, you need to inventory your previous startup investment co-investors and list them in a spreadsheet. If you've invested in 10 startups through syndicate websites, your spreadsheet should have about 500 potential investors. Second, add their LinkedIn, Twitter, and Facebook links to the spreadsheet and send friend requests on these social platforms. Your friend request can say something like, "Hi, Mr. So-and-so, I invested in the same startup as you," to create a sense of connection. After this, you need to open these social platforms once or twice daily, like their posts, interact with them, and maintain a presence. This simple yet effective process of distributing social currency helps you establish basic social relationships with these insiders. The third step is to selectively email the most prominent investors, inviting them for a meeting. During the meeting, focus on learning about their recent investments, why they invested in those projects, and what assistance they provided to the startups. Also, don't forget to ask about any interesting projects they are currently evaluating and share your recent investments, asking if they would be interested in meeting the founders. The author emphasizes that every meeting with another investor should be treated as an interview where you present your best self. In today's society, capital is everywhere, but good projects are extremely rare. Remember, those truly good projects are always completed before anyone else knows about them. Therefore, you must present well enough for seasoned angel investors to introduce you to their treasured projects. Once this door of trust opens, you can start accumulating resources and building your project sharing network with other investors. Third part, screening projects. Once you have your private project flow through your project sharing network, the next step is to screen projects. First, you need to clarify your investment track, that is, the industry of the project. In the author's view, there are only two types of tracks in the world: those with explosive growth potential and others. Explosive growth refers to the ability to achieve valuations in the billions and increase stock value hundreds of times. The author notes that traditional industries like restaurants, movies, clothing factories, and breweries rarely reach this level, no matter how hard the founders work, except in very rare cases. You might argue that traditional enterprises like McDonald's, Starbucks, and Lululemon have reached giant levels. However, behind their massive scale lies decades of accumulation and growth. Most of us cannot wait for 3 to 4 decades to slowly build wealth, and neither can angel investors. They seek companies that can grow into giants within 5 to 10 years. In this regard, information technology companies outperform traditional companies. Why? The underlying economic principle is simple. The expansion boundary of a company is determined by the marginal revenue and marginal cost of each expansion unit. As long as marginal revenue exceeds marginal cost, the company will continue to expand until they are equal. The fundamental difference between traditional companies and IT companies in expansion lies in their respective marginal cost trends. For example, McDonald's expansion involves selling more burgers or opening more outlets, with costs almost fixed. The cost of opening the 9th store is not much lower than the 8th. In contrast, software companies like Google and Uber expand by gaining more users for their software, with the cost of adding an extra user being negligible once the software is developed. Only when they reach an upper limit do they need to significantly increase operational and maintenance investments before continuing to expand. This is why the author recommends that angel investors focus on the IT track instead of traditional tracks. Standing on this track, how do we screen specific projects? The author tells us to focus not on the idea or the market but on the entrepreneur. People don't represent everything, but they are the only criterion. This is a phrase the author repeats on his blog. No one can predict whether a company will succeed, but we can judge whether the person starting it can succeed. To make this judgment, we need to conduct an interview with the entrepreneur. Imagine a scenario where an entrepreneur is sitting in front of you. How do you determine whether they have the potential to create the next Google, Facebook, or Uber? The author provides 4 key questions to ask. First question: what are you doing? This question sounds like, what does your company do? Or why should I invest in your company? But these questions focus on the matter, not the person. We need to recognize that Google's success lies not in being a search engine company, but in its founder's ability to create superior software that helps people search for information faster. Asking, what are you doing? Better focuses on the entrepreneur and what they are doing. Second question, why are you doing this project? You might hear various answers to this question. The author reveals 2 of the worst types of answers he has heard as an angel investor. The first type is to make money. The author notes that if someone starts a business just to make money, they will likely give up. Why? Suppose you can develop a top-notch search engine. In that case, you must be a top-notch programmer. For someone with such abilities, if they only want to fill their wallet quickly, they can let Google or Facebook hire them, earning $1 million annually in stock and salary. Why take on the enormous risk and invest a lot of energy and resources to develop software independently? In short, entrepreneurs motivated by money soon realize that many other avenues offer quicker, greater returns in the short term than starting a business, and they will stop pursuing the long-termism needed for entrepreneurship. The second type of bad answer is because a successful company didn't do this feature. For example, after the author invested in Uber, many people recommended Uber for food delivery, Uber for shared helicopters, and Uber for shopping. The author believes these entrepreneurs lack foresight as they focus on developing supplemental features for other companies' products rather than creating a complete product or pursuing a grand mission. Even if such companies succeed temporarily, they usually get squeezed out by big companies or cheaply acquired, never becoming unicorns. So, what is the right answer to why are you doing this? It varies from person to person. For instance, Uber's founders might tell you they started because they couldn't get a taxi in Paris during a tech conference. Facebook's founder, Zuckerberg, might say he created a social platform due to his fear of socializing and difficulty interacting with the opposite sex, allowing him to know people's social statuses. This may sound simple or childish, but consider, is there anything more important than procreation? According to Darwin and Freud, no. Thus, Zuckerberg's social anxiety created the fastest-growing consumer product in human history. Third question, why now? The author believes this is the most crucial question. In the tech field, many people repeatedly attempt the same ideas. Looking at today's internet giants, it often feels like they succeeded because they were the first in their field. But the reality is, Facebook was the 10th social platform, Google the 12th search engine, iPad the 20th tablet, and YouTube was one of countless video sites. They weren't the first but became the best. The author tells us, it's not about who does it first, but who does it first when conditions are ripe. Take Uber, for example. Before Uber, another startup tried to help people book taxis via their phones, answering the "why now" question with text messages. But text messages were insufficient for phone-based ride-hailing. Such services needed high-performance processors, intuitive large touchscreens, and military-grade GPS accuracy, which became Uber's answer to "why now?" Similarly, YouTube appeared after many video sites, but the collapse of the internet bubble reduced broadband costs, and cloud computing lowered network storage costs. This allowed YouTube to avoid charging video publishers high server fees. Instead, it shared ad revenue from popular videos with the publishers, driving the creation of high-quality grassroots video content and fueling YouTube's rapid rise. Fourth question: what special advantages do you have? A sharper way to ask this is, what makes you think you can do this project? Or, what unique advantages do you have over competitors and followers? Many interviews end with this question because many entrepreneurs can't answer it. However, we must admit that if founders have special advantages, their startups are more likely to succeed. For example, Google's founders attended Stanford and knew many brilliant algorithm programmers. Zuckerberg was a Harvard student familiar with campus culture and the potential market for an online social platform. Bill Gates' mother, Mary Gates, chaired the United Way of America, where IBM's CEO was also a member, creating the opportunity for IBM to hire Microsoft to develop the first PC operating system. Does this mean those without special family backgrounds, education, or skills can't succeed in entrepreneurship? Of course not. But the author reminds us that an angel investor's job isn't to nurture dreams or generate love, but to sift through the mixed project stream to find the one most likely to become a unicorn. After asking these 4 questions, you should understand what the entrepreneur wants to do, can do, and why. If you feel they pass, you can delve into their business model, market strategy, team composition, and other specifics. In conclusion, this is the core content I wanted to share from this book. Besides these, the book includes operational details and question lists for angel investors to evaluate projects and entrepreneurs. If interested, you can read the original ebook linked at the end of this manuscript. The book's primary value seems to be providing a guide for those who want to become angel investors or attract angel investors' attention. But if we're not interested in wealth creation, is there still value in learning this angel investment mindset? The answer is a resounding yes. Even if we never become angel investors or evaluate future Zuckerbergs or Facebooks, we all evaluate at least one entrepreneurial project in our lives, our own. For example, how do we find a higher return for our time and human capital? Should we choose a bed in a big city or a house in our hometown? How do we judge the expansion potential of a company or industry? If something fails, is it because the idea was flawed or the people or conditions involved? Essentially, this is a book about decision-making and judgment. The author uses his experience to show that wise decisions are more critical than inefficient diligence, and correct judgment is more valuable than a wealthy background. The book includes a passage. Entrepreneurship or angel investing is like being placed in a vast, dark gymnasium with a light switch somewhere. You fumble in the dark, not knowing what you're doing, until you find the small switch, press it, and light floods your vision. This switch is akin to the opportunity we all seek in life. Value investors excel at befriending time, while angel investors excel at dancing with opportunities. Their essence is identifying opportunities. This inspires us to see that for those with an angel mindset, Any era can be a golden age full of opportunities. That's the essence of this book. The original book link is attached at the end for further reading. You can also click the share button below the video to share this book with your friends. Congratulations, you've just finished another book.